Hello. Yeah, let's look at this example on how to determine or to find the gross profit and to determine the ending inventory when we've been given beginning inventory and its related cost, and we also have additional units that were produced during the year. And for this case, the company uses FIFO inventory accounting. So again, with this problem we have, so again, the best way to approach the inventory accounting is this. From what we know is that beginning inventory plus the purchases, these two result in cost of goods available for sale. So this is what is available from which the company can sell units. And then if they end up selling some of the units, so it becomes cost of goods sold. And therefore, what is remaining goes into the ending inventory account. So we have the beginning inventory plus cost equates to the cost of goods available for sale. And then if we sell them, it goes into cost of goods sold, and whatever is remain unsold becomes part of the ending inventory. So once you know this, then we can work with this problem. So our beginning inventory here is 10,000 units, and the cost is what we've been given. So the cost of this is $8. $4 for the material, three for labor, one for overhead. So, and therefore, we are talking of 10,000 units here in terms of units. And in terms of dollars, our beginning inventory is 10,000 times 8, and that will be 80,000 as part of beginning inventory. Then the company also bought additional materials, which is additional units, 23,500. So they bought an additional 23,500 units. So what is available for sale in terms of just units? So you have 23,500 that's available, but remember you had 10,000 that were there from the beginning. Now the company has, in terms of units, they have 33,500 units that are available for sale. In terms of dollars, for purchases, this is $9. For so additional the additional purchases were 23,500 units at a material cost of $9, but then labor and overhead were the same. So these additional units, the total cost is $9 for the material, $3 for labor, and $1 for overhead. So we're talking about $13. So we times $13 will give us our total cost of the purchases. So you have 13 times 23,500. This puts this. This is basically in terms of dollars, we have that 305,500, right? Okay, just think about it. So this is what our cost of purchases are. But remember, you had a beginning dollar value of 80. So if you take the 80 and you add to 305,000, this will give you your dollar value of the cost of goods available for sale. So in terms of dollar value, your cost of goods available for sale is 385,500. Again, I'm just taking this 80,000 plus the 305,000, where 305,000 represents the cost of the purchases and 80,000 represents the cost of the beginning inventory. So in terms of dollar value, we have 385,500 as cost of goods available for sale, and we have 33,500 in terms of units. So these are the units, these are the units, these are the units, right? Okay, so let's move on. Then we are told in terms of sale, the company uses FIFO, basically means fast in, fast out. So if they sold the units, first of all, the truth is the 10,000 will have to go fast, or part of the 10,000 has to go fast before they can even sell from the 23,500 units, because it's fast in, fast out. So in this example, we've been sold, assuming convex sold 25,500 units during the last 6 months at $18. So, in terms of the cost, so in terms of the cost, because the question is asking us for the gross profit, right? So, the gross profit, we are simply saying gross profit is equal to revenue minus cost of goods sold. So, what we are trying to determine then is our revenue and cost of goods sold. But remember, our revenue is just we sold 25,000 units, 500, and we sold this for how much? For $18. So our revenue for sure is 25,500 times $18. Our revenue is 459,000 is our revenue, the proceeds from the sale of the units. But what is our cost of goods sold? Remember, our cost of goods sold, so the cost of goods sold, we say we sold 25,500 units, but we are using FIFO, which means that fast in, fast out. So what happened then is that we sold these 10,000 units first. So those units were sold first, but remember, what is the cost of those 10,000 units? The cost is 80,000 because it's 8 times 80. So times 8, then our cost for this is 80,000. Or we just pick up that 80,000. Then we sold 25,500, of which 10,000 is coming from the beginning inventory. It means then the remaining 15,500 units, right? From 25,500, we sold 10,000 from the beginning inventory. Fast in, fast out. It means the remaining 15,500 came from these purchases. So it came from these additional purchases. But what is our cost of the purchases? Remember, the material cost is $9, overhead is $1, labor is $3. The cost for that is $13. So it's 9 plus 3 plus 1, and therefore the cost of this is $13. So if you take 15,500 times 13, then we are saying 201,500 is the cost of the additional 15,500. So the total cost then is taking the 201,500 and you add 80,000, and this gives you a total cost of goods sold of 281,500. Again, this is the cost of goods sold. This 23,000, no, this 23,000, not 23, this 25,500. The cost is 281,500. So if you take the 459,000 minus the 281,500, then this gives us a gross profit of 177,500 becomes the gross profit.